Hello everyone, I am Madhuvitha Govindasamy from Group 3. Today we are going to present about demonstration of calculations for several questions that given by our lecturer. Well, to start from the question 1, as we can see, it is required to answer for question 1 is the weighted average cost of capital. So in order to calculate the weighted average cost of capital, which is WACC, we begin with calculating the cost of debt. So as for the formula for the cost of debt is coupon payment divide market price times in bracket 1 minus tax rate. So as for the coupon payment, we can see that it is written at here. Okay, and as for the market price, it is written at that. So it is given that 90 per 1200 times 1 minus 0.30. So as for the answer, 0.075 times 0.007, which gives the answer of 0.0525. And second, we need to calculate the cost of preferred stock, which comes from the formula dividend divide market price. Dividend, we can see that it's written 8.50 and the market price is RM100 for preferred stock. So the answer will be RM 0.085. As for the common stock, it is dividend divide market price plus growth rate. So for dividend, it's 3.00, which is written over here, and divide 16, which is for the market price, and plus with 0.05, which equals to 0.2375. So in order to calculate, we already find out the cost of debt, cost of preferred stock, and also common stock. So we can proceed to calculate the weighted average of cost of capital, which is WACC. So as for the weights, for WD, it is 2 divide 8, which gives the answer of 0.25. So this is, as we can see, this is the calculation of the million funds. So we can see 2.0, 2.5 and 3.5 respectively. So for WP, it is 2.5 divide 8, which gives the answer 0.3125. For WE, it is 3.5 divide 8, which gives the answer 0.4375. So last but not least, for WACC, it carries the formula WD times KD plus WP times KP plus WE times KE. So to solve this, 0.25 times 0.0525 in bracket plus 0.3125 times 0.2375 plus 0.4375 times 0.085. So as to solve this, 0.013125 plus 0.0742185 plus 0.0371875, which gives us the answer for WACC 0.1245. Okay, as for the B, we are required to calculate the weighted average flotation cost. So for the flotation cost, FD equals to 7%, FP equals to 3%, and FE equals to 4%. So weighted average for flotation cost, the formula stands for F equals WD times FD plus WP times FP plus WE times FE. So using the previous calculation, 0.25 times 0.07 plus 0.3125 times 0.03 plus 0.4375 times 0.04 equals 0.0175 plus 0.09375 plus 0.0175 equals 0.044375. For the next question, we are required to calculate the true cost of funds. True cost equals to WCC plus flotation cost. So for the WCC, it is we calculated that before, which stands for 0.1245, and the true flotation cost is also 0.044375 equals to 0.16888. As for the fourth question, it is asked that in this particular case, we use the market value of debt. However, in practice, it is often assumed that the market value of debt is equal of the book value of debt. Why is it is often necessary to make this assumption in practice? To answer this question, simplification. Using the book value simplifies the calculation, the cost of debt, as it eliminates the need to estimate the market value of debt, which can be complex. As for the second answer, it is practical. For practically, the difference between the market value and book value of the debt is relatively small. Last one, data availability. Book values are typically readily available and easily accessible, where market value may not be readily available or maybe require significant research and also estimation. As for the question 2, it is written that, well, the characteristics of perfect capital market is when there is situation with no taxes, no bankruptcy cost, no transaction cost. Besides, in this case, the securities are divisible and investors have the privilege to borrow or lend with risk-free rate on the same time. As for the question 2, it can be received that question asks for cost for equity, so which is WACC equals to RE, which stands for 12%. So for 2B, it is asked for RE, which is equals to WACC plus in bracket WACC minus RD times D divide E times 1 minus tax rate, which equals to 12% plus 12% minus 8% times with 0.25 divide 0.75 times 1 minus 0.35 equals to 12% plus 0.866, which stands for 12.87. For 2C, convert to 50% debt, where the calculation will be like this: RE equals to 12% plus 12% minus 8% times 0.50 divide 0.50 times 1 minus 0.35. RE equals to 12% plus 4% times 0.65. RE equals to 12% plus 2.6, which equals to 14.6. As for D, it is asked for WACC with 25% debt with 50%. WACC equals E divide V, RE plus D divide V times with RD times 1 minus tax rate. For 25% debt, WACC equals to 0.75 times 12.87% plus 0.25, as the debts need to stand with WACC with 25% times 8% times 0.65. It is given that 9.6525% plus 1.3, which gives us answer of 10.9525%. For 50% debt, WACC equals 0.50 times 14.67% plus 0.50 times 8% times 0.65 equals to 7.3% plus 2.6 equals to 9.9%. As for the third question, WACC equals to 11.5%, cost of equity 16%, cost of debt 8.5%, tax rate 35%. For the debt equity ratio D divide E, WACC equals to E divide V times RE plus D divide V times RD times 1 minus tax rate. 1 minus 0.35 will equals to 0.65, which gives us the tax rate. 11.5%, this is remains, we didn't calculate this, so it remains as question mark, times 16% plus question mark as well, x times 0.65. Let EV equals to x and DV equals to x as well. 11.5% x times 16, x times 16% plus 1 minus x times 5.525%. 11.5% equals to 16x plus 5.525 minus 5.525x. 11.5% equals 10.475x plus 5.525, which eventually we can evaluate 5.975 equals to 10.475, x equals to 0.570. As we can see, based on this question 1 and 2, it is mainly focused on WACC, which is weighted average of cost capital. So Weighted average of cost of capital is usually represents the discount rate for calculating the value of business. So, from my opinion, it is important to know WACC because it is used to evaluate investment opportunities, as WCC is considered to represent the firm's opportunity as the cost of capital.
Good day everyone, I am Selvamalar daughter of Sengodan. Now I am going to explain about the question 3. So question 3, the first category of question is you need to find the crossover rate. So the crossover rate, you need to compare the NPV of two projects, which is NPV Aravind Resort and equals to NPV Bryant Resort. So the NPV's formula is cash flow divided by 1 plus R, which is power of N. The N is years. Okay. Minus with initial investment. Initial investment in this project is 30,000 and 60,000. Okay. The first step of the crossover rate is you need to rewrite the equation, which is NPV Aravind Resort equals to NPV Bryant Resort, which is I already write the questions. Okay. Negative 30,000, which is initial investment, I put in front of it, plus with 10,000 for year 1, 10,000 year 2, 10,000 year 3, 10,000 year 4 and 10,000 year 5. This is for NPV Aravind Resort. For the second is NPV Bryant Resort. Rewrite the same equation. 60,000 negative 60,000, 20,000 divided by 1 plus R year 1, 20,000 year 2, 20,000 year 3, 20,000 year 4 and 20,000 year 5. As we can see in the question, they did then given the rate, which is R. So the first you see the right equation, right? Like how I write NPV Aravind Resort equals to NPV Bryant Resort. So now you need to do some equation, which the next step is move the initial investment in one side. So what I did, I bring the 60,000 and minus 30,000 minus 60,000. So it will give the 30,000. So then equals to, you need to, I just now say the move the initial investment, right? So you need to write like this, 20,000, 1 plus R plus 20,000 year 2, year 3, year 4, year 5 minus with 10,000 year 1, year 2, year 3, year 4, year 5. Just now I explained the step is move initial investment in one side. So now you need to simplify by combining like terms. The 30,000 remains constant. So now you need to find the same terms, which is 20,000 divided by 1 plus R year 1 minus 10,000 divided by 1 plus R year 1. So you need to follow like this, year 2, year 3, year 4, year 5. Just now I explained about the simplified combining like terms. So when you simplify that, you minus the 20,000 minus 10,000, you will get like 10,000, 10,000, 10,000 for 5 years. So you will write like this. So the next step is you need to factor out common terms. The question, they remain all the same amount for year 1 until year 5. So as you can see here, the remain constant of the term, the factor out common terms is 10,000. So the 30,000 remains same. The 10,000 is factor out, which is common thing for 5 years. So which is, I write it down like this. Then you need to simplify that. 1 plus R, 1 divided by 1 plus R for 5 years. So just now we factor out the common terms, right? You need to simplify the expression, which is 30,000 equals to 10,000. You need to, for this equation, you need to assume the rate. I will explain further information. So you need to simplify the expression like this. 1 divided by 1 plus rate equals to 3. So you move the 10,000 to divide by 30,000. So you will get the 3. So this is the means your present value must be equals to 3. As you can see, just now I say that you need to assume the rate. So the rate means you can assume any number. The equation for this you can do in the calculator, which means financial calculator, and use Excel. But when coming the exam, you don't know how to use financial calculator. There is no Excel means it will hard for you to identify the rate. So I easy explain to you how to find 3 equals to present value, which means present value must equal to 3. So now I assume the rate is 20%, which is 0.20. So I will do all the equation like this. 3 equals to the formula of this, t equals to 1. So 1 plus 0.20, the u1. So continue, write everything. So now you assume the rate is 20%. So now we calculate that we get the 3 equals to 3 exactly or not. So now you implement the equation that I wrote in that whiteboard just now. So bracket 1 divide by 1 plus 0.20 power of 1. So continues, do like that. So now I implement every equation until for 5 years. So there is just we get 2.99, which is closer to 3. So the 20 is closer to 3 means you can use 0.19. So just now from the calculator you can see the 3 present value is not equals to 3, which is 2.99. Your present value must be equal to 3. So we use rate is 0.20 means which is the number can close to 20. Maybe I assume rate is 0.19, which is 19%. So I calculate again like this. So come, we again calculate in the calculator whether we can get the present value equals to 3. Now you can see that I implement the equation for rate assuming is 0.19. So we calculate until 5 years. Let's see the present value we getting is equals to 3 or not. So everything I implement ready. Now I'm going to check. So we can see that 3.05, which is near to 3. So now maybe I can take the rate is 0.19, which is you can see that 3 equals to 3.05. So we can assume the rate is 0.19. So the crossover rate is 19%, approximately 19%. Now we're going to compute the NPV of both projects. From the question A, we're going to use the rate for the NPV formula, which is NPV equals to cash flow divided by 1 plus R power of N minus with initial investment. So just now we calculate the rate is 0.19, which means 90%. So can we calculate for Arabian resort? NPV equals to 10,000 divided by 1 plus 0.19 power of 1. So continue until power of 5 for 5 years. So you will get the 576.35 by minusing the initial investment, which is 30,000. So you do the same like for Brian Resort. The number of Brian Resort from year 1 until year 5 is 20,000. So you just put just write the formula, but replace the 10,000 with 20,000. So you will get the NPV for Brian Resort is 1,152.70. So as you can see here, the last question is Jihadi need to choose the best project. So now the NPV of Brian Resort is higher than NPV of Arabian Resort. So Jihadi can choose Brian Resort. Why? Because NPV higher makes the profitability. So I suggest Jihadi to choose Brian Resort, which can the project gives Jihadi a best profitability. So the financial knowledge. How this question is connected with the financial knowledge. As you can see, in this question, Jihadi need to choose a best project. So in the real world of life also, we going to do an initial investment. We need to do investment means we need to choose a best company. So you need to calculate the NPV of the project. So NPV project, which means get higher, means you can use that as a your best investment to avoid the risk in your real life.
So hello everyone, my name is GANAPATHI G.BALA. So as we can see, we're going to see for the solution for the question 4. So when we see the question 4, we have to find for the NPV. So to get the NPV, first of all we have to find for the OCF. So this is the formula for the OCF. OCF in bracket price minus variable cost times with quantity minus with fixed cost times with 1 minus tax plus depreciation times with tax. So we have to do for 5 years. So let's see for the first year. So we have to find operating cash flow first year. So for the first year, 380 minus 265 times with 9300 minus with 1200000 times with 1 minus 0.35 plus 2400000 divided by 5 times with 0.35. This 0.35 is tax. So 35% is tax. So we get 10655000 minus 78000 plus 168000. So the answer will be 11595,000. So as well as for the second year. So this all information we will get from the question itself. So when we move to the second year, so when we calculate the OCF, we will get 380 minus with 265 times with 105000 minus with 120000 times with 1 minus 0.35 plus with 2400000 divided by 5 and with 0.35. So we will get this, and the overall answer we will get 12975,000. So as per the same formula for the third year, so 380 minus with 265 times with 128,000 minus with 120,000 times with 190.35 plus 240,000 divided by 5 times with 0.35. So when you do, we will get 147,200,000 minus with 78,000 plus 168,000, we will get 15620,000. So as far as for the fourth year, okay, we have to do. So we will get 380 minus with 265 times with 134,000 minus with 78,000 plus with 168,000, we will get 163,100. So when we move for the fifth year, for the operating cash flow, we will get 380 minus with 265 times with 187,000 minus with 78,000 plus with 168,000, we will get 109,05,000. Okay, let's move for the method. So to simplify the method, I use the table formula. So we can see OCF, we get 1159,500 as we calculate just now, and 1297,500 for the second year, 156,200 for the third year, for the fourth year 163,100 for the fourth year, and for the fifth year 109,05,000. Okay, so for the initial NWC minus 10,000, so the changes in NWC will be you have to take the present additional NWC minus with past additional NWC. We can get from the question as well. So you will get minus negative 35,010,000. For the second year, you will get minus 684,000. For the third year, you will get 1313,000. For the fourth year, you will get 342,000. For the fifth year, you will get 267,900. So the NWC recovery will be 180,000. So for the initial update, you will get a negative 24,000,000. So for the after tax salvage value, so for the after tax salvage value, the formula will be salvage value minus T, salvage value minus book value. So how to get the salvage value is you have to get from the 20% from the 24,000,000. So you will get 48,000,000 minus with. So for the T, you have to get 35%. The tax value, the tax percentage from the 48,000,000. So you will get 168,000. So if you minus means you will get 312,000. So that's the salvage value. So for the total projected cash flow, you have to for the total projected cash flow, you will get from minus the changes NWC minus with OCF. So you will get this. For the first year, you will get 809,400. For the second year, you will get 122,91,000. For the third year, you will get 140,09,000. For the fourth year, you will get 159,680. For the fifth year, you will get 185,04,000. So the 25,800,000 will be your initial investment. So for the discounted date, will be the 20%. So for the first year, you have to take the total projected cash flow minus with the 20% plus 1. So you will get 1.2 lah. So you have to divide, you will get 674,500. For the second year, you will get 8535,471. For the third year, you will get 82,80671. For the fourth year, you will get 77,00617. For the fifth year, you will get 74,36342. So when you plus everything and minus with 258,000, you will get 1289,8448. Okay, so as I mentioned just now, we get the NPV 1289,8048, which is positive NPV. So when the NPV of this project is positive, which is RM 1289,840 for 48, the project should proceed with accepting the new project lah. So the project positive NPV is that it will benefit the financial well-being and expansion of the company. Okay, so that's all for the for A question. Let's move to the for B lah. So for the for B, we have to find for the depress. So for the depress, we have to get from the OCF formula lah. So how for the OCF for the OCF value, we have to get from the NPV. So we have to find the NPV to get the OCF as well. So for the NPV formula, there will be OCF in bracket PBIJ, comma N, and also minus initial outlay. So we know the NPV formula. So assume NPV is 0 lah. So 0 equal with OCF, PBIJ 40, and also the 6 and minus 3, 24000. So when we move here, it will become 24000 equal with OCF. When we look at the PBIF table, it will be 3.8887. So when we move here, it will become divide. So when we do this formula, we will get 61717.28. Okay. So the 14% we can get from the question itself, its rate of return 14%, and for the 6 is 6 years lah. So we have to check in the PBIF table to get this value. So let's move on. So now we are going to search for the midrange from the OCF formula. So we already calculated OCF. So the OCF formula will be OCF equals to price minus with variable cost times with quantity minus with fixed cost times with 1 minus tax plus with depreciation times tax. Okay. So we already get the OCF formula 61717.28. The price we have to find for the price. So minus with the variable cost 160 and times with quantity 100 minus with fixed cost 50000 times with 1 minus tax. The 40% will be the tax. So 1 minus 0.4 and plus with 2400 divided by 6 times with 0.4. So we will get this amount 61717.28 equals to P minus 160 times with 100 minus with 30,000 plus with 1600. So for the second part, 61717.28 equal to 100 P minus 1600 minus with 4600. So for now we have to do this. We have to minus this. So we will get 30,000. Okay. So we do. Okay. So when the negative is equals to positive lah. So after this we have to bring in front, so it will become negative. So 61717.28 minus 30. So when we plus this, we will get 91717.28. Okay, so we have to bring this here, so we can divide lah. When we divide 91717.28 divided by 100, we will get 917.17. So the bid price per unit is RM 917 ringgit per 17 cent. Okay, so when we look at the whole question, for A and also for B, it's related to the principle of corporate finance and also it's related to the real world environment rule. So when we look at the principle of corporate finance, this both questions also related to the principle of corporate finance, which is forecasting, and also we get financial information as well. So when we look at the real working environment as well, so let's say for example, if a company wants to launch a new product or they want to expand their market, they want us to do the projected cash flow. So from that we will get the financial information. So from the financial information we can take a wise decision to expand our market. So these both questions are very important and also aligned with the principles of corporate finance and also real working environment.
So this is the answer for the question 5. So based on the table and based on the first question, the question wants to the NPV of the merger for the firm 2. So basically kita akan masukkan rumus dia, iaitu price per share firm T darab share outstanding firm T tambah synergetic firm T price firm T willing to be acquired times share outstanding firm T. So kita akan masukkan dalam rumus tu 25 darab 800 plus 3,500, which is the price firm T willing to be acquired and already stated in the question. Tolak 28 darab 800, kita dapat 20,000 plus 35,000. Tolak 400 and we get this answer which is 1100. Next question iaitu price per share. Untuk price per share ni kita gunakan rumus yang hampir sama dengan ini, cuma ada sedikit perbezaan. Untuk price per share firm B, kita akan darab dengan share outstanding firm B. Kita akan tambah dengan net present value from this question. Lepas tu kita akan bahagi dengan share outstanding firm B. Jadi kita akan masukkan dalam rumus 35 darab 1200 plus 1100 dan kita akan bahagi 1200. Dapat 87,900 bahagi 1200 dan untuk price per share kita akan dapat RM35.91667 ataupun RM35.92. For the question C, dia minta merge premium part A, which is from this question. So kita akan kira share outstanding firm T didarab dengan price at which firm T willing to be acquired tolak price per share firm T. So untuk soalan ni kita selesaikan dulu part price at which firm T willing to be acquired tolak price per share firm T. Lepas tu kita akan baru kita bagi dengan share outstanding. So untuk jawapan tu kita akan masukkan dalam formula, kira satu persatu 800 28 tolak 25 unit, kita dapat 12,400. So untuk soalan D, question 5D, diberikan situasi bahawa firm B dia offer 3 share for every 5 share firm T. So soalan tu tanya berapakah price per share merge for firm B. Jadi untuk kira ni kita perlu cari the new share of B issued. Untuk kira kita akan gunakan share outstanding for B didarab dengan 3/5. 3/5 ni adalah dari sini, iaitu 3 share for every 5 share for B. So masukkan dalam rumus 800 darab 3/5 dapat 480. Tapi itu belum selesai sebab ini baru new share for firm B. Untuk kira the value of the merged firm, kita guna rumus ini dan masukkan ke dalam rumus seperti ini. 35 darab 800 tambah 25 darab 1200 plus 35,000 dapat 61,500. Untuk soalan E, dia minta net present value merge in situation B, which is from this question. Jadi untuk kira tu masukkan dalam rumus price firm T kita darab dengan share outstanding firm T plus synergy firm T tolak price firm D darab new share B, which is this answer. Lepas tu masukkan dalam rumus dapat 6,619.99984 ataupun 6,620.
For the question F, the answer for two defensive tactics commonly used by target firm manager to resist unfriendly takeover attempts is poison field and staggered pot. For the poison field, when an acquirer obtains a specific percentage of the target's share, the target company may use a poison field approach, in which case it may issue a large number of shares to current owner or offer them at a substantial discount, thereby diluting the acquired stake, because it becomes more costly to acquire a controlling interest. This makes the purchase less appealing to the acquirer and make expensive. For the second one is staggered board. A staggered board, also known as a class board, divides the board of directors into classes, each of which serves a staggered term. This makes it difficult for an acquirer to achieve complete control of the board in a single proxy war or takeover attempt. It increases the time and effort required for an acquirer to replace a majority of the board, giving the target firm more time to consider alternatives or negotiate more favorable terms. So that.
Okay, so ini adalah jawapan untuk question 6. So based on the question, kita akan keluarkan semua maklumat daripada soalan itu. Pertama, kita dapat initial outlay which is 450,000 dan past 5 years iaitu 5 tahun operating life and no salvage value, dan taxes dia bagi sebanyak 30% dan divide return 15%. Dan sini saya kira depreciation terus, which is kita ambil IO, kita bahagi dengan 5 tahun dan dapat 90,000. So untuk soalan pertama, dia minta accounting break even. Untuk kira accounting break even, kita guna formula fixed cost plus depreciation bahagi dengan price tolak variable cost. Kita masukkan fixed cost 200,000 tambah depreciation 90,000 bahagi price 150 tolak 100 dapat 290,000 bahagi 50 dan dapat 5,800 unit. Before that, untuk soalan ini dia minta accounting break even untuk best case scenario. Untuk soalan kedua, dia minta best case net present value. Dan untuk kira net NPV ni kita perlu ada nilai OCF, PBIF dan tolak dengan IO. IO kita ada sudah, tapi untuk OCF ni kita tiadakan. So kita perlu cari. Untuk OCF ni kita perlu ada nilai EBIT dan juga nilai tax. Tapi dalam soalan ni dia tidak bagi, jadi kita perlu cari sendirilah. Untuk formula EBIT ni kita perlu gunakan formula unit sale, kita darab dengan harga, tolak variable cost plus fixed cost dan tolak depreciation. Masukkan dalam rumus ni, kita dapat 120,9900. Lepas tu EBIT sudah dapat, kita boleh kira untuk operating cash flow. Untuk operating cash flow, nilai EBIT tambah depreciation tolak tax. EBIT kita dapat 120,9900 plus depreciation dari sini 90,000. Dan untuk nilai tax ni dia bagi situ 30%. Jadi untuk dapatkan ini kita perlu kira daripada EBIT, which is 12099 darab dengan 30%. Masukkan dalam rumus, dapat ini dan totalnya kita dapat 1044930. Jadi tapi di sini belum habis ya, sebab untuk best case NPV ini kita perlu guna rumus ini. Jadi masukkan dalam rumus ini kita dapat ini nilai OCF. Lepas tu PBIF ini kita dapat 3.3522 tolak dengan initial outlay. Kita dapat 3052814.346. Okey, ini adalah jawapan untuk soalan yang ketiga. Dia bagi question which is nilai NPV if company expect the worst case scenario. So basically kita akan kira macam rumus yang untuk question tu, kita gunakan EBIT dengan OCF dan nilai dari PBIF tu. So macam biasa kita cari EBIT, guna rumus sel, tolak variable cost, tolak fixed cost, tolak depreciation, masukkan dalam rumus 11700000 tolak 85 tolak 150,000 tolak 90,000, kita dapat 1229915. Untuk OCF kita gunakan nilai EBIT, kita tambah dengan depreciation dan tolak dengan tax. Jadi masukkan dalam rumus, kita dapat 1688895. Sudah dapat EBIT dan OCF, kita boleh terus kira untuk net present value. Jadi kita gunakan rumus IO, negatif IO, tambah dengan nilai OCF darab dengan PBIF. PBIF ni 15% periodnya, which is 5 tahun. Jadi kita dapat 5211495.38. Jadi berdasarkan soalan 6 ni kita dapat simpulkan bahawa dalam company itu mungkin terjadi basic scenario, worst scenario dan juga best scenario. Jadi untuk mengetahui apa yang akan terjadi in the future, kita boleh gunakan formula ni untuk predict.
That's all from us. Thank you.